Hi, in this video I'm going to tell you how to figure out if the business that you're considering investing in is a good business. This is very important because a lot of times people invest in mediocre or bad businesses and they think that just because maybe they're cheap, that's going to be a good investment, and frequently that's a good way to lose a lot of money. So please make sure to stick around until the end. My name is Gary Mishuras. I'm the Managing Partner and Chief Investment Officer of Silver Ring Value Partners. I also teach the Value Investing Seminar at the F.W. Olin Graduate School of Business. So a lot of times when people start out investing, and this happened to me as well, I started almost 20 years ago at Fidelity as an equity analyst, and the thing that we focus mostly on is how cheap is the stock, or is the PE low or something like that. And the reason, it's obvious, it's easy to tell. And by the way, on average, cheap stocks over long periods of time do well. So it's not a terrible way to look for stocks, but I think that it takes much more judgment and nuance to really think about the quality of the business. And so why is quality important? Well, first of all, think about what you're doing when you're valuing a business. You really are thinking about what's that future stream of cash flow between now and eternity, and what's the net present value of that. That's all you're doing. And then you're looking at the price and you're comparing it to that future value of cash flows, and you're making a judgment if there's enough margin of safety, if the gap is big enough between the price and the value. Well, so if you take a business that's just a really crappy business, and 1 year it earns $1, next year it loses $1, and who the heck knows what's going to happen with it, it's really hard to figure out what that stream of cash flow looks like. So you might say, well, but it's at 7 times earnings or 6 times earnings. That's nice, but what if they earn nothing in the future, or they go out of business? That can easily happen. A lot of businesses fail, and a lot more businesses have declining earnings, for instance, that people never think about. So I think that before you just go on and buy something that's cheap, think about the business quality. And to me, it's really about how predictable is the future cash flow stream. So if you were to look out 5 to 10 years, how likely would you be able to approximately be able to tell what the key economic characteristics of the business are? Now, the perfect business has the following 3 characteristics. It has high returns on capital that's deployed in the business. It has high returns on the incremental capital that can be invested back into the business. And it has very large amounts of capital that can be invested at those high incremental rates of return. So that's the ideal quote compounder that everyone looks at, but that's rare, right? So I would say it's not so bad to have a business that has a good moat, meaning a good competitive advantage, so very predictable economics, but maybe it doesn't have attractive investment opportunities, and also has a management team that essentially knows that and just is happy to return capital to the shareholders. That's still a good business. That's still predictable, very analyzable. It just might not be as valuable as some other business that has that plus the ability to reinvest at high rates of return. But that you can easily find. So I would say focus on those things. So keep in mind what's the return of on capital, how predictable is the business, and how likely are you, and this is the key, you as an investor looking out, say 10 years into the future, how likely are you to be able to roughly tell what the business economics will look like? If you like this video, please hit like and also subscribe to my YouTube channel. Thank you guys.